Warm welcome. This is morning at Bolpur Shantiniketan. It's a rural belt, a bit away from Kolkata. So, as promised, this is the Greeks video. I hope this goes well. Now, this is my understanding of Greeks. So, let's get down to the point. Before we get into Greeks, a very basic primer on how an options price is actually composed. Now, any options price has two components, intrinsic value and extrinsic value. So intrinsic value is the value of the option if it were to be exercised at current price. Matlab, if expiry is today and the option you're holding, if the expiry happens right now, what would be the value of your option? Matlab, in the money, what price would remain? That is the intrinsic value. Extrinsic value is total value of time in the option. That means the option price minus the intrinsic value, whatever is left is the extrinsic value. We also call it the time value. So an options price has two components, intrinsic and extrinsic. There's no part of any Greek in this. Greeks do not constitute the component of an option price. What are Greeks will come to later. Now, ATM and OTM options are 100% extrinsic value, while in the money options are more intrinsic and less extrinsic value with further ITM strikes. So what we should remember is any option which is ATM or OTM, whether a put or call, is basically 100% extrinsic or time value. And any in the money option will have some intrinsic and some extrinsic value. The same thing I have written here. Now what you are seeing in front of you are two lines. One is a yellow line, one is a blue line. The blue line is basically the price of the option. And the yellow line which you see is basically the intrinsic value of that option. So if Nifty is at 11604, it's an old PPT slide. And if you see below 11600, the intrinsic value actually increases as you go more in the money. But from 11600, you see the intrinsic is basically flat. So everything is extrinsic, right? Calculation, intrinsic value of a call option is price of the underlying asset minus the strike price. That is, let us say you are in a stock which has a 200 rupee call. The price of the call is 10 rupees. Okay. And the stock is quoting at 205. Now, if expiry happens now, your call of 200 strike is 10 rupees and expiry is at 205. So you will get 5 rupee back. That 5 rupee is your intrinsic. So total price is 10 rupees minus 5 rupee intrinsic. Your 5 rupees extrinsic value in that call. In the money put options, intrinsic value is strike price minus the price of the underlying asset. That will give you the intrinsic value of a put option. Extrinsic value key points, lower as we go deep in the money. Whatever deep in the money option we buy, it will have the lowest extrinsic value. Highest extrinsic value is obviously at ATM. Again, extrinsic value as a component will get lower as we go OTM. It is fully extrinsic, but the value is low. All call options, ATM and above strikes are 100% extrinsic value. All put options, ATM or below strikes are 100% extrinsic value. Now, since this is a YouTube video, I won't be repeating this. You can always come back and see the slide once again. Now let us come to Greeks. Once you have understood intrinsic and extrinsic, please understand the Greeks actually tell you how the extrinsic value will change with different changes in values, right? Nothing actually happens to the intrinsic. So first Greek is delta, which tells you how much the value of an option will change due to change in the underlying price, that is change in the futures or the spot price on which the option is based. Gamma is a second order Greek that tells you how much the delta will change due to a change in the unit of the underlying, that is the stock of future. Vega is how much the value of the option will change due to a change in volatility of that particular stock. Theta is obviously the change in the value of the option on account of time. Rho is change in the value according to how the interest rate changes. These are the basic Greeks we need to know. Delta, Vega, Theta and Rho are first order Greeks as they directly estimate if the underlying value changes, how much a value of an option will change because of these factors. Gamma is a second order Greek because it kind of estimates the change in delta due to a change in underlying. First is delta. The delta of an option is the sensitivity of the option's price with respect to a change in the price of the underlying asset, correct? So that same 200 rupee call, if you have bought at 10 rupees, if the future goes from 200 to 205, the value of your call will increase. That's a positive delta. If from 200 the stock falls to 190, the option price of 200 10 rupees will decrease. So your delta is basically going down. The delta of a call option can lie between the values 0 and 1. As a general rule, in the money options will move more than out of the money options, and short term options will react more than longer term options to the same price change in the stock. As expedition expiry nears, the delta for in the money calls will approach 1, reflecting a 1-to-1 reaction to price changes in the stock. That means if you are a near expiry, the same 200 rupee option which you have at 200 rupees strike call which you have at 10 rupees. Now, if the stock is at 205, your call is obviously 5 rupee in the money. So now if the stock moves 1 rupee, your option will also move 1 rupee. It will approach 1. Delta for out of the money calls will approach 0 and won't react to at all to price changes in the stock. That's because if they're held until expiry, calls will either be exercised and become stock, or they will expire worthless or become nothing at all. So far OTM options near expiry have almost zero probability of becoming in the money. So the price crossing those particular strikes. So the delta actually approaches 0. A call's delta is the slope of its price curve. If you look first at the red line, this is how basically a call payoff chart is kind of plotted. So on this plot, wherever you are actually tells you the delta. So if the slope is very sharp, you're on that, delta is close to 1. If the slope is flat, your delta is close to 0. If your slope is in the middle, the delta is 0.5. This is a European call option delta graph. Delta is close to 0 when the call is deep out of the money, rises to 0.5 when call is in the money, and moves close to 1 as the call moves deep into the money. The delta of a put option is opposite, can assume a value of -1 and 0. As expiry approaches, the delta for in the money puts will approach -1, that is, it will move as much as the stock is falling, and delta for out of the money puts will approach 0. Obviously, that's because if puts are held until expiry, the owner will either exercise the options or sell stock, or the put will expire worthless. This happens here also because we have physical delivery in stocks. Now, puts delta is also equal to the slope of its price curve. Same thing. If the put is out of the money, delta is close to 0. If the put is at the money, delta is 0.5. If the put is deep in the money, delta is close to -1. So delta is close to -1 when the put is deep in the money, moves to 0.5 when the put is at the money, minus 0.5, and moves close to 0 as the put moves deep out of the money. So this is how delta functions in a put. Now the previous explanations which we saw were textbook definition of delta, which comes from the Black-Scholes model. But here's another way useful to think about the delta. The probability of an option will wind up at least 10 paisa in the money at expiration. Technically, this is not a valid definition because the actual math behind delta calculation does not involve advanced probability calculation. However, in the options market, delta is frequently used as a kind of synonym for probability. Okay. So when an at the money call option has a delta of 50, we all know this, or 50 delta, that's because there's a 50-50 chance the option ends up in the money or out of the money at expiration. Think in this manner, a 200 strike call you are holding, correct? The stock is exactly at 200. It is 1 day left to expiry. Now expiry can happen at 201, can happen at 199. It can be happening up or down also. But a single 1 rupee change makes your call in the money or out of the money. So if the stock is expiring at 201, your 200 strike call is in the money. If the stock is expiring at 199, your 200 strike call is out of the money. So at the money option has a 50% probability that the stock will be in the money or out of the money. So that is why it is 50 delta. Fine. Now let us look at how delta begins to change as an option gets further in or out of the money. As an option gets further in the money, the probability that it will be at money at expiration increases as well. So the option's delta will increase. As an option gets farther out of the money, the probability that it will be in the money at expiration decreases. So the option's delta will decrease. Like stock price, time until expiry will affect the probability that options will finish in or out of the money. That's because as expiry approaches, the stock will have less time to move above or below the strike price of your option. Because probabilities are changing as expiry approaches, delta will react differently to changes in the stock price. If calls are in the money just prior to expiry, the delta will approach 1 and option will move paisa per paisa with the stock. If the in the money puts will approach -1 as expiry nears, exactly opposite. If options are out of the money, they will approach 0 more rapidly than they would further out in time and stop reacting altogether to movement in the stock. On expiry day, you will see if you're on a 200 strike call and the price is 200, the 230 strike call does not move even if the stock is moving 5 rupees because the delta or the probability that the stock will go to 230 in a single day is practically 0. So as expiry approaches, changes in stock value will cause more dramatic changes in delta. due to increased or decreased probability of finishing in the money. This dramatic change is obviously in the money, at the money options. Okay. This one slide sums it up on what causes delta to change. A change in the underlying price, obviously. A changes in implied volatility, if the volatility of the stock changes, or the changes in time. See the first graph. If the underlying moves down, let's say you are holding a call, 50 delta call, ATM call, right? So if your underlying moves down, the 50 delta call might become 20 delta call. So delta has changed because the underlying has moved down. We are considering that the price is moving down. If the implied volatility moves down, the volatility of the stock decreases. The 20 delta call becomes a 5 delta call because 5 or 10 or whatever. Because when implied volatility comes down, the chances of the stock making a large move comes down. That changes the delta of the stock. When time elapses, say you are on a 5 delta call, it becomes a 0 delta call. Because the more time goes, more chances that the stock will go up and hit that particular OTM call, which has a 5 delta, decreases. So that becomes 0, right? So what causes delta to change? Changes in underlying price, changes in implied volatility, changes in time. This motamoti covers delta. Now let's come to gamma or second order Greek. The gamma of an option is the sensitivity of the option's price with respect to a change in the delta of the option. Gamma is a second order Greek as it estimates the impact of a first order Greek delta. Gamma is identical for a call and a put option with the same strike, maturity and underlying asset. Gamma is the rate that delta will change based on a 1 rupee change in the stock price. So if delta is the speed at which option prices change, you can think of gamma as the acceleration. Options with the highest gamma are the most responsive to changes in the price of the underlying stock. So all this talk about gamma boils down to one single point. I will write this again later. The price of near-term at-the-money options will exhibit the most explosive response to price changes in the stock. Let me explain this. As of now in markets, we have weekly, we have monthlies, we have next month options, and let us say we are focused on Nifty. Nifty is at say 15,800. I have a 15,800 weekly call, I have a 15,800 monthly call, I have a 15,800 monthly means say July call, and I have a 15,800 August call. So the biggest impact of gamma will actually be on your 15,800 weekly call. That will have the biggest impact of gamma. So gamma's impact maximum is on the nearest expiry option and at the ATM. Remember these two things, you will be okay. Rest of the things you probably don't have to focus that much. Note, if you are an options buyer, high gamma is good as long as your forecast is correct. That's because as your option moves in the money, delta will approach more rapidly. But if your forecast is wrong, it can come back to bite you rapidly by lowering your delta. Now, this is a theoretical line. How do you use this? The way I use this is whenever I am day trading options on Bank Nifty or Nifty, Bank Nifty trades you have seen, you will almost always see me remaining at the money in options. Whether I'm buying calls when I'm expecting market to go up or buying puts when expecting market to fall, I'm always at the money options. In fact, I have a different video on this that why you should trade at the money options if you're trading intraday in options. Okay. Now, if you're an option seller and your forecast is incorrect, high gamma is the enemy. That's because it can cause your position to work against you at a more accelerated rate if the option you have sold moves in the money. Simple explanation, if you are on an expiry day, do not sell at the money options. That is the biggest impact of gamma and that will kill you very fast. Or if you have sold an option which is out of the money and it is about to become ATM, that's why you should be extremely careful, adjust your position or cut your position. Gamma reaches its maximum value when an option is close to being at the money and declines as the option moves further into or out of the money. The features of gamma can be seen by noting that gamma is the slope of the delta function for both the call and the put option. Since the delta of the call and the put differ by a constant, the slopes of their delta functions are also equal. In both cases, the slope of the curve reaches the maximum value near the strike price of the option, which is ATM. Since the call and put delta function have positive slopes throughout, therefore gamma is always positive. Now, if this is a graph and this is a gamma graph, basically the peak which you see is actually that is the ATM option, correct? As you go out of the money, gamma will decrease. As you go in the money, gamma will decrease. So gamma is a threat or an advantage only when you are at ATM. The gamma of an underlying asset is obviously zero. Since a futures forward contract is a linear instrument, its delta is a constant. Therefore, the gamma is zero. The futures contract has zero gamma as delta is always 1. This is my note. I am worried about gamma as a buyer or as a seller only when my option is near ATM. If it is not near ATM, you do not need to focus that much on gamma as a trader. Because as a trader in real time or in a position, there are n number of things we can watch. So we have to kind of focus when it is more important. So if your option, whether you bought or sold, it is at the money, that's where you should focus on gamma. If your option is in the money or if your option is pretty out of the money, gamma is not that much of a factor. So always focus on, if your option is at ATM, then what is the gamma doing? Let's come to the next Greek, which is theta. Theta of an option is the sensitivity of the option's price with respect to a change in the time to maturity. Theta is also known as the option's time decay. Time decay or theta is enemy number one for the option buyer. On the other hand, it is usually the option seller's best friend. We know this. Theta is an amount the price of calls and puts will decrease, at least in theory, for a one-day change in the time to expiration. In the options market, the passage of time is similar to the effect of a hot summer sun on a block of ice. Each moment that passes causes some of the option's time value to melt away. Therefore, not only does time value melt away, it does so at an accelerated rate as expiry approaches. At the money options will experience more significant rupee losses over time than in the money or out of the money options with the same underlying stock and expiration date. That's because, remember, at the money options we saw in the first slide had the highest extrinsic value. That is the highest time value built into the premium. And what I said, intrinsic value and extrinsic value. Extrinsic value is always totally time value. So since the biggest time value is at ATM, the biggest theta loser will always be the ATM option. And the bigger chunk of time value built into the price, there is more to lose. Keep in mind that for out of the money options, theta will be lower than it is for at the money options. That's because the rupee amount of time value is smaller. However, percentage-wise loss in an OTM option theta might be greater than the percentage-wise loss in an ATM option. Remember that also. This actually has a bigger implication while trading, but that would be a bit advanced, maybe later. So this is the call theta and this is the put theta. This is the call theta and this is how a put theta can be graphed. Let's come to Vega then. Vega of an option is the sensitivity of the option's price with respect to a change in the volatility of the underlying asset. You can think of Vega as the Greek who is a little shaky and a bit hyper. Vega is the amount call and put prices will change in theory for a corresponding 1-point change in implied volatility. Vega does not have any effect on the intrinsic value of options. It only affects the time value of an option's price. Typically, as implied volatility increases, the value of options will increase. That's because an increase in implied volatility suggests that increased range of potential movement for the stock are expected by the option buyers and sellers in the market. That's why they are increasing the vol. So the stock can make a bigger move. Implied volatility is derived from the actual prices in the options market and is not given by the Black-Scholes formula as such. You take the actual prices, feed it to the Black-Scholes and actually back calculate to get the implied volatility price, correct? So this is truly an unknown and the most dangerous Greek for both buyers and sellers. Vega is identical for a call and put option with the same strike, maturity and underlying asset. Vega is always a positive and is a function of the option's moneyness. Vega reaches its maximum value when an option is close to being at the money and declines as the option moves further into or out of the money, just like gamma. At the money options which have the biggest Vega impact. In the money and out of the money options, Vega impact will be lower. Because again, time value is the biggest at the money. This is basically the Vega curve. If you see, the highest point is at 50, which is actually the ATM price, strike price. So Vega is the highest. It goes down as you go ATM or as you go in the money. Let's come to rho. This is the most Greek which you actually don't have to look at. Rho of an option is the sensitivity of the option's price with respect to a change in the risk-free rate of interest. For a call option, rho is positive. For a put option, rho is negative. For now, just keep in mind that if you're trading shorter term options, changing interest rate wouldn't affect the value of your options too much. But if you're trading longer term options like leaps, rho can have a much bigger significant effect due to greater cost of carry. So unless you're trading leaps, that is far away options like December 21 or December 22, where in like July 21, rho should not affect you. Weekly, monthlies, rho does not have that much of an effect. Now, why do we need to understand the Greeks? So many things. Because an options price moves in 3 dimensions: direction, volatility, and time. You need a view on all 3 to trade options successfully. Direction is given by delta, volatility is given by Vega, time is given by theta. Now, what are the common myths of Greeks? Myth 1, Greeks are what make up an options price. This I hear a lot time. No, an options price is simply intrinsic value and extrinsic. Intrinsic value we understood how to calculate. Extrinsic is simply time value, and options does not have anything else. It does not have delta, Vega, theta built into it. Nothing. Greeks explain what can happen to an options price, provided the underlying price changes, provided the volatility changes, provided the interest rate changes, anything changes, right? Second myth, Greeks are timeless, they never change. That is, if I do a Greek calculation today, it will hold for the next 2 days, 3 days. Forget it. Greeks are continuously changing even intraday. What they show now will change in the future. So if you're doing Greeks analysis, your analysis should be continuous and dynamic. Number three, delta neutral is the goal of option trading. This is a myth because delta neutral for us retail traders with a small capital is not that important. We will not get that amount of returns. Myth, you can trade options successfully without knowing Greeks. This is my opinion. Reality, no, you can't. You need a basic understanding of actual Greeks to trade options properly. Understanding Greeks is very tough. This is another myth. Now, reality, it's not. The basics can be picked up by anyone with reasonable intelligence. Last myth, this is fun actually. You need not to know about myths about Greeks or anything else. You can just trade options. Reality is, yes, you do. You need to know what are the misunderstandings, then understand it and then trade. Now, does this complete understanding of Greeks? Absolutely not. What we have learned so far is the basic understanding of Greeks. While trading options, whether naked or in the form of different strategies, there's a continuous interplay of these Greeks. Analysis of these Greeks, their interaction and changes can help a trader to, one, find the optimal strategy for a given scenario. Whether you go for a naked call, you go for a bull spread, bear spread, butterfly, back spread, whatever. The Greeks dictate what kind of strategy you will use, what would be the strikes, what would be the expiry, what would be the ratio, everything. Number two, understand risk. Greeks tell you that if the underlying changes or wall changes, what risk can be there in your position. Number three, in some cases, can even predict direction. Number four, know when and how to adjust a position, whether at profit or at a loss. So if you do an understanding, if you have an understanding of Greeks and if you analyze Greeks, these are the advantages which you can have. I'm not covering this in this particular video because this is supposed to be absolute basics, but let us see what is the response. Maybe we can cover this later. Now, a disclaimer, what I've explained in my understanding of the Greeks as a trader and not a theoretician. I do lack the nerd level maths required to understand the Black-Scholes formula as much I would have liked. I am also still learning, okay? So I urge all viewers to read the books I have referred to themselves, understand the topic better. I might have made minor unintentional mistakes or omissions, if any, though I have tried my best to properly explain the concept. Focus was explaining without the maths involved. I have extensively used books and articles available on the net to gather the knowledge required to make this video. Whatever I have covered is easily available in public domain. These are the three books which I will refer. Thank you for viewing the video. The first book is Options, Futures and Other Derivatives, John C. Hull and Sankarshan Basu. This book is actually the textbook for any options course in say FRM or MBA or anywhere, right? The second book is my personal favorite for a starter, The Bible of Option Strategies by Guy Cohen. Very simple language. The third book, if you want to go advanced, very mechanical, very systematic, you want to go deeper into the maths, it's Options, Volatility and Pricing by Sheldon Nattenberg. So if you read these books, I will suggest you start with number 2, The Bible of Option Strategies as a trader. After you do this book, go back to 1, Options, Futures and Other Derivatives. It's kind of a text, kind of a dull, but do go through it. The theoretical understanding is important. Then go through Option, Volatility and Pricing. That will give you much more advanced understanding of Greeks. If you already know the basics, I will suggest go to number 3 straight, Option, Volatility and Pricing. Okay. So thank you. I would like your views on this. If you like this, dislike this, whatever. And based upon response, we can do something later. Thank you for watching.